If you're a company or if you're an association, I think one of the things that the last year has taught is that it's very difficult to plan. Now you have to go by something, and I think that the next year is going to be tough, but when the recovery comes, it's going to be quite dramatic. And it's very important, in fact, during tough times for businesses not only to do the right thing as far as not spending too much money and not sticking your head out, but actually let me go back and let me do this again, because I think there's something else here. How do you plan if you're an association or a business? One of the things the last year has taught is it's very difficult to do. But if we look back on history, what we see is it's very difficult to predict downturns. It's very difficult to predict upturns. And when the upturn comes, it will be quite dramatic. And one of the things that's going to happen is that what always happens in a recession, which is the strong survive, and you're going to see some consolidations, and there will be companies that are in a position, actually a stronger position than they were at the beginning of the recession. But I think it's wise to plan for the next 6 months being flat. If it's flat, you're doing pretty well, and make plans accordingly. But to completely strip your company of your assets, your resources, your human resources, your training, that sort of thing, that's not a very good idea in my opinion. I think that's a mistake. Well, let's not forget that America's gross domestic product is about $13 trillion. So we're talking about big numbers here, but we're still in the single digits as far as percentage of the total economy. The real key is what the money gets spent on. Now, in my view, spending money shoring up the financial system is an absolute necessity. You don't necessarily have to spend money to do that. You can simply have the U.S. government stand behind these financial institutions. But you have to worry that the more the government gets involved, the more decisions will be made by these institutions that government begins to control that are not good economic decisions, that they're more political decisions than economic decisions. So that's something to worry about. As far as the stimulus package is concerned itself, I think the key is what government spends money on, not how much it spends. There are good things to spend money on, and there are bad things to spend money on. And we've got to really watch that very carefully. And there's a little paradox there, because making these decisions does take time, and we need stimulus quickly. So the best way to get quick stimulus is through the tax code, possibly by sending out checks. But I think at this point, sending out checks is not going to do very much. People are going to save that money or use it to buy down their credit card debt. I think a better approach would be full-scale renovation, real reform of our entitlement programs, and then at the same time cutting the payroll tax. That would put money into people's pockets immediately, and if they knew it was a long-term change, then I think we'd see some actual economic growth as a result. You know, what is the great asset of America? The great asset is our ability to do things with imagination, to start businesses, entrepreneurship, taking risks. All of those things, it seems to me, are in jeopardy if we over-regulate. And certainly there were regulatory lapses over the last few years. You can see it with Fannie Mae and Freddie Mac, and there are many examples of this. But if the heavy hand of government, and it tends to be heavy, comes down too hard, then we're going to discourage entrepreneurship, imagination, the kinds of things that have made this country great. And we're going to lose our comparative advantage. This is what makes us the country that we have been, the economy that we have been over time. So we've got to take measures that preserve the risk-taking that's part of American life. Now, I'm not talking about ridiculous, excessive risk-taking of the sort that we saw in finance and in real estate recently. I'm talking about the kind of desire that people have to start their own business and to be rewarded as a result. And regulation can stifle that. High taxes can stifle that. The reason I have optimism is, number one, we know historically that recessions end, that asset values like real estate values, stock values bottom out, and they tend to bounce back very quickly after a severe downturn. You know, even if you go back to the Depression and you look what happened in the stock market, you saw severe declines, but then you saw quick bounces back. Now, you also saw some declines because there were a lot of bad public policy decisions that were being made. But the point is that we do reach equilibrium, we do reach a bottom, things come back. And the best way to see that is certainly with home prices. Home prices got way out of control, but they're now coming down, and when they get down into the area where people feel that they're valuable enough, interest rates are low and probably will be low for some time, people are going to begin buying houses. So, you know, you do bounce back. Economies do reach equilibrium points, and the excesses that we had on one side are now being balanced by excesses on the other side, but we are going to get back to normal. Well, I think in the early stages there was a lot of criticism of the United States, blame. We get blamed for practically everything, and we were certainly blamed for this one, that the decline in the economy around the world is the fault of the United States. I think there's a lot less talk like that now. And look, investors have their own choices. Banks have their own choices. It was the choice of banks throughout Europe, for example, to buy up a lot of subprime debt based on American mortgages. That was their own choice. We didn't hold a gun to them to say, you got to buy this stuff. They thought this was a good investment. They were wrong, as a lot of investors in the United States were wrong. Also, much of the excess that we saw, again, let's just focus on real estate, in the United States was duplicated in other parts of the world. Britain is a very good example, but much of Europe, it was the same thing. And it was caused by the same factors. Very, very low interest rates, artificially low interest rates. Now in Europe, they're slightly higher than they have been in the United States. A desire by governments to get more people into homes because they felt that that was a public good. And finally, the availability of new financial instruments that made it much easier to fund residential and commercial real estate. So those things were going on all over the world. To blame them on the United States, I think, is a little bit ridiculous. The real question is, are we in a period that's different, significantly different? Has something changed, or can we go back and look at history for answers? And my answer to that question is, we have to look at history. We don't have anything else. And I think when we look at history, what history teaches us about the stock market is that over short periods of time, there's a huge amount of volatility. Very striking ups and downs. And we just had a year in which people lost, the broad indexes lost 35%. People lost a third of their money in stocks. But what history teaches us is that if you're able to keep your money in these same companies, in a broad, diversified portfolio of companies, that you're going to come back. How long will it take to come back? How long do you need to keep your money invested for the safety that it will come back? And I think the answer to that is about 10 years. And we've had a very rough 10 years. So there's some 10-year periods that are really bad. There's no doubt about that. But in general, having a time horizon of 10 years, 15 years would be even better. You can feel pretty comfortable being invested in the best businesses in the United States, plus some businesses abroad, and you do that through the stock market. So I am still a very big advocate of investing in stocks. And you know, I also think that this last period has taught us that investing in debt, that is to say bonds or debt securities, can be as risky, if not more so, than investing in stocks. Now, Treasury debt has certainly held up very well, but other kinds of debt, corporate debt, municipal bonds, securities that are based on mortgage debt, that kind of thing, those have turned out to be very, very poor investments. And that's why I continue to be a major advocate of stock market investing. People with shorter time horizons, though, if you are about to retire, one of the things that this episode has taught is that you really do need a ratio of stocks to bonds, stocks to your total portfolio, let's put it that way, that is lower than a lot of people thought it was. That it's probably, if you might have thought it was 50-50, it ought to be more like 25-75 stocks to bonds.